Good afternoon, everyone. Thanks for joining us today. Welcome to Miller Value Partners Live Update, April 2026. I'm David Yazdan, and I'm joined by my colleagues, Portfolio Managers Bill Miller IV and Dan Lysik. After updates from Bill and Dan, we'll open it up to Q&A. If you have a question at any time, click on the Q&A icon at the bottom of your screen, type in your question, and then press Submit. We've already received over a dozen questions in advance, so we hope to get to as many as we can. Now, before we get started, we've provided access via the Resources button at the bottom of your screen, and then after you hit that, you can choose the Document tab to access our mutual fund fact sheets and a new advisor piece that we titled Shifting Market Leadership, Expanding Client Opportunities. If you're an advisor and you'd like to receive a copy, please drop a comment in the chat and we'll send it to you. Think of it as an advisor's guide for navigating clients through what we believe to be a massive market regime change. For years, investing felt simple. Own the index, stay invested, and let mega cap growth drive returns. That was easy beta. It was easy. It felt repeatable, and it was cheap. What's not to like? Think about it, though. For most millennials, people aged 30 to 45, and all Gen Zers who have entered the workforce, they've only experienced one kind of market. Buy the S&P and call it a day. It's created a recency bias that reminds us of the boiling frog metaphor. Perhaps Jim Grant of Grant's Interest Rate Observer put it best. In science, knowledge is cumulative. In finance, knowledge is cyclical. His point is that markets don't learn the way scientific disciplines do. Investors repeatedly rediscover the same lessons. Valuation matters, cycles turn, risk is real. And like clockwork, human behavior resets every cycle. So as we enter this new market cycle, favoring stock pickers, wake up before the water boils. We recommend that you revisit your passive approach to public equities and right-size your portfolios to a more durable mix going forward. Moving to fund performance, all of the data I'll reference is as of quarter end March 31st. For Miller Income Fund, symbol LMCLX for the iShares, we seek to identify undervalued yield-producing securities of all sizes across the capital structure. The fund's portfolio breakdown currently is approximately 75% in common stocks. The rest is in bonds, REITs, and preferreds. Roughly 73% of the fund's equity exposure is in sub-$10 billion market cap stocks. Miller Income is benchmarked against the Bank of America High Yield Index, which the fund has outperformed for its year-to-date 1-year, 3-year, 5-year, 10-year, and since inception returns, and inception was a little over 12 years ago. Highlighting recent performance, the fund's 3-year average annual return of 20.26% compares favorably to its benchmark, which averaged just 8.58% for that 3-year period. Moving to Miller Value Partners Appreciation ETF, the ticker is MVPA. MVPA's flexibility allows the portfolio to pursue undervalued opportunities across market caps, sectors, industries, and geographies. It complements a core equity allocation by providing diversification away from passive and style-constrained strategies. Roughly 74% of MVPA's assets are invested in sub-$10 billion market cap equities. Since inception, January 30th, 2024, so approximately 2 years and 2 months, NVPA produced an average annual return of 11.69% versus 15.41% for the S&P 500 index. NVPA lagged the S&P 500 in Q1 with a negative 5.68% return versus negative 4.33% for the index. The recent drawdown was attributed more to short-term market volatility as opposed to any permanent impairments to the underlying businesses. Contrary to the pullback in their public market prices, our portfolio holdings are experiencing business improvements and growth, which, in our view, offers an additional discount to an already undervalued portfolio. For Miller Value Partners Leverage ETF, ticker is MVPL. This active ETF is a long-term strategy based on our algorithm. In Q1, MVPL returned a negative 6.77% versus, as I said before, negative 4.33% for the S&P 500. However, since inception, which was February 27th, 2024, so roughly 2 years and a month, MVPL had an average annual return of 19.83% versus 14.26% for the S&P 500. And our Miller Deep Value Select strategy, we're restricted on what we can share here. Eligible investors need to be qualified clients. So if you'd like to learn more, please email me directly at diazdan@millervalue.com. Now let's get to the meat of the call. In his Q1 commentary titled, "Feels like 2022, but isn't," Bill breaks down why this year's choppy first quarter echoes the market texture of early 2022, but importantly, why the underlying fundamentals today are far more stable. So I'll hand it over to Bill now to share his perspectives on the current market backdrop and related opportunities. Bill?
Thanks, everyone, for the time and attention on this call. We know those are your most valuable resources, and we appreciate you spending them on us today. I'm going to try and be brief here. We got so many questions on a lot of the topics that I think are pressing on people's minds that I'm just going to hit briefly on my shareholder letter called "Feels Like 2022, but Isn't." It's available on our website, millervalue.com, right now. And then I'm going to answer questions at the end of the call on a lot of the most pressing topics, so stick around. So the market texture today feels a lot like 2022. What happened in 2022? Well, Russia invaded Ukraine. There was strife. There was inflationary pressures. Oil spiked to the moon, and value outperformed growth, but in a big way. And so did SMID. We think that trend is just getting going. But if you look at what happened in the effects of the strife today in Iran, what has it done? Well, it's slowed growth expectations at the margin. So the Federal Reserve Bank of Atlanta has a live forecast of what's going on in the economy from a real growth perspective, and they reduced that estimate from 3.2% prior to the invasion or to the bombing to now 1.3% over the span of just 1 month. And all of that decline is coming from reduced contributions from both personal consumption and residential investment. And so bond investors saw this. They flattened the yield curve from a 4-year high of 73 bips between the 2 and 10-year spread. Investors look at this as a harbinger of economic activity. And so steepening generally means the economy is accelerating. Flattening is not a good thing. But again, we're still in positive territory. There's still 51 basis points there of difference. And we're hoping this is all short-lived. And the other main point I made in the letter is that the economy is actually in a far different place today. So if you looked at what happened in 2022, when oil prices shot up, we were already at an inflation rate of 7% prior to that even happening. Right now, we're at a much lower inflation rate. I just came in north of, I think, 3. But and again, that was caused by tariffs. So the economy is in a much better place today than it was in 2022. We're hoping this is short-lived. It looks like at the margin, all things are moving in the right direction with talks. But then now let's take a quick look at what happened on equities and why we're still optimistic on value here. One thing that I think people haven't contextualized yet, and I wrote about this in a shareholder letter a while back, but if you look at the real cost of capital, capital has a cost again. Capital had no real cost between 2010 and 2020, actually, right around that. Real rates of return on bonds, the difference, call it, between the average 10-year rate and the average inflation rate last decade was only about 0.6%. So you had very little opportunity cost and ability to generate cash and safe assets that decade, which encouraged risk taking out the curve, long duration assets to appreciate in value, and to the point where they're now, we think, very overvalued relative to smaller and mid-cap securities that kick off excess cash flow that aren't being reinvested in the business and that are being given back to you as shareholders. So I think that's one of the reasons that the income fund's done so well. and why, because names that kick off yield, growthy names don't kick off yield, right? They're reinvesting all the cash flows. Value-oriented names tend to kick off more yield, and that's the types of equities that are in our income fund. So I think it's important to contextualize that moving forward. A lot of people are still massively overweight growth, and so we still think it's a really good idea, and that there's actually a lot of leg room to value outperforming growth, even though it's done so by a lot this year. Let's just take a look at the info tech sector, right, in the S&P 500. Despite it getting whacked this year, it still trades at roughly the 85th percentile on an EV to EBITDA basis, going back 30 years. So that looks relatively expensive. Valuation returns tend to be high valuation and tends to correlate with low returns, so they're inversely correlated. And we think that's very important for people to keep in mind, and that's why we should be pushing our value allocations here. I'm going to turn it over to Dan, who's going to talk more about this dynamic and give you a lot more data than I just did. But Dan?
We put together a couple slides like we've done in the past, so I want to kind of walk through those because I think they do a good job of kind of capturing kind of the recent market movements. In particular, what's been happening in the marketplace with the volatility. I think it's great for us to actually look at and kind of use this framework going forward, probably for the next couple of calls. But we'll look at the first slide that comes up. That slide is going to highlight to you actually looking at value. If you look on the right hand of that slide, values-led growth. If you look in the down equity market, values had positive returns across all market caps. The relative outperformance was significant, 700 to 1,200 basis points, as Bill mentioned. In addition, we're on this chart, you can see that we're also micro, small, and mid-cap value led the market, and the spread between small cap value and large cap growth was also significant, near 1,500 basis points. On the left is a chart of the S&P 500 forward PE multiple. We discussed in the last call, in the last 30 years, the average PE multiple is about 17 times. Last year, we closed near 22 times. During the first quarter, we saw contraction back to 19.7 times. Due to the recent pullback in large cap growth companies, which make up a significant weighting. And from quarter end through yesterday, that directional improvement in the Iran war that Bill walked through, the marketplace has returned to what has worked in the past. They rotated back to longer duration equities and mega caps, which has actually reinflated the PE multiple. And so we're back at 22 times, similar to where the market was at the end of the year. And in the chart in the middle, you can see that the CAPE cyclically adjusted PE multiple ended the year at the quarter at 37 times, which also has moved up closer to 40 times as of this morning. On the next slide, we look at market expectations. And if we think about where market expectations are today and compare them to historical, the 25-year annual revenue growth has averaged about 5%. Margin expansion has been 2.5%, for a long-term average of 7.5% for earnings growth. For 2026, consensus expectations are for higher than average 8% revenue growth, 9% earnings from margin expansion. And so AI is obviously being a positive contributor to margin expansion over time. And if you think about margins where we're sitting today and walk through productivity enhancements, you can think about margins now are at 25-year highs. They've been up and to the right over the past 25 years, with only pullbacks done in recessionary time periods, and 2022, obviously with the spike in oil, which reeks out inflation rates well above historical averages. Bill would highlight again the differences today. The tax bill we talked about previously, it's $150 billion to consumer pockets today, corporate tax breaks. All these things I think are positive and continue to kind of support in the near term with higher energy prices. The one difference today, maybe than the beginning of 2024, there hasn't been any reset of consensus expectations. So expectations are higher than where we were last year. The market actually adjusted tariffs and assumed flat earnings growth, thinking about 25 versus 24, which allowed the market to kind of exceed in expectations. So again, I think we're still set up pretty well when we think about the equity market in general. The main risk would be any kind of move back in higher energy prices that would surprise and cause kind of margin pressure. And again, we think that scenario is a headwind more for longer duration equities like we saw in the first quarter. On the next slide, it kind of charts the largest market caps. The chart on the right highlights how the market, which was down 5% in the first quarter, to the Magnificent Seven down 11%. The remaining companies are actually only down 1%. And if you look at the chart on the left, top 10 companies in the S&P 500 over the past 30 years, you can see how the S&P 500 weighting at 38%, still well above where the earnings contribution was, is 33%. As of this morning, the S&P 500 top 10 weighting is back near 40%. So the recent valuation expansion has increased levels back near historical peaks. And then the chart in the bottom right, we walk through the CapEx for the major AI hyperscalers. A good portion of these are within the mega caps, and they've transitioned, as we discussed previously, from capital light to more capital intensive models. Free cash flow as percentage of sales has fallen from 18% just back in 2023 to 5%, less than 5% this year. So again, market expectations are looking through, expecting improving free cash flow in the next couple of years as the rate of CapEx slows and revenue growth reaccelerates. And given the significant step up in CapEx, the unknowns that we still don't know are ongoing spending levels, incremental margins, and growth next couple of years. So if free cash flow goes negative, given higher spending or growth expectations are reset 2028 plus, there could be a future re-rating that could occur. On the next slide, we look at and discuss briefly long duration and their contribution and concentration in large cap and growth indexes. We've used this slide in the past to highlight how the market cap, if you think about the S&P 500, price to sales greater than 10 times. There's numerous studies going back showing that that group tends to underperform the market over a longer time period. Back in October, we were near 35%, greater than 10 times within the S&P. Over the past 6 months, that underperformance has seen a pullback to 20%, where we end the first quarter. This morning, which is surprising, 15 days, we've actually gone from 20% back to 35%. So we're now back at October highs. And the chart highlights also the price to sales of IT companies. Bill walked through EV to EBITDA multiples on a price to sales basis. The IT sector is back over 9 times above 2000's peak. The Mag 7 is actually greater than 11 times. So similar to late October, we think it's a great time again to think about revisiting diversification away from longer duration equities. And we think the setup, it looks pretty interesting. The next slide, we highlight the opportunity set. We continue to see mispricings on lower valuation subsets of the equity market. We think we're in the early innings of a multi-year broadening cycle. Expectations are low. Investors remain significantly underallocated. The upper right is top 10 versus the entire U.S. equity market. Valuation spreads remain wide. Small caps and mid caps are underrepresented in the passive indexes. Chart on the left looks at the weight of mid-cap stocks in the Russell 1000. Year-end, you hit a 60-year low of 20%. And last quarter, we highlighted small caps trading at an attractive 4P discount to large caps. However, we think the valuation attractiveness is understated. So as we've highlighted in previous slides, large caps are near peak margins. Small caps are coming out of a multi-year earnings recession. And so thinking about price to sales between large and small caps, it lines up perfectly with the 15-year outperformance cycle. And so basically you've seen a significant expansion on large cap versus small cap. And so we're now well above where we've been for prior peaks. And even with the outperformance in the first quarter, large caps are still above prior peaks and 4 times higher than where they were at the beginning of the outperformance cycle. So again, low valuation, small mid-cap relative earnings growth, improving over the coming year. We think that's a catalyst for the market to continue to broaden and narrow the kind of ongoing wide valuation spreads. On the next slide is the first of 2 stocks I just want to briefly mention. The first one is Crescent Energy. The symbol is CRGY. And so Crescent, obviously being in the energy space, it's a smaller market cap. It doesn't match, kind of their significant asset base as a top 10 E&P company. Unlike some of their peers, they don't focus on production growth, but free cash flow generation. Companies built a platform that's flexible to move within liquids and generate the highest possible returns. And management's, focused on being a best-in-class capital allocator. They've completed value creation acquisitions, deep discounts to intrinsic value, improved the operations over time. And their recent Vital Energy deal is more than 35% accretive to free cash flow. Chris, and also has an underappreciated minerals and royalty businesses, which generates 160 million of EBITDA. We can see public, private companies valuation multiples. That's 1 to 1.6 billion of embedded value. And they're also one of the largest Gulf Coast producers and well positioned for increasing LNG. And this is also a hidden AI play because of the data center demand that comes out of that market. So again, market expectations low, valuation multiples, discount to peers, 2 times cash flow, 3 times forward EV to EBITDA, a nice 4% dividend yield. Within the energy space, also just want to mention we also own Neighbors, symbol NBR, Chord Energy, CHRD, and then Alliance Resources Partners, the symbol is ARLP. And then the final slide that just briefly I want to highlight, the Iran wars also led to market volatility. The spike in oil prices created concerns around the consumer. So we think that's provided, opportunity sets to look specifically for within the restaurant sector. And so we're highlighting Bloomin' Brands, symbols BL, MN's currently trading at $6.50. It's 80% below its recent highs. It's a 550 million market cap company that has nearly 4 billion in revenue. So the restaurant banners, you might be familiar, Outback, Carrabba's, Bonefish, Fleming's. Companies undertaken a multi-year transformation. It's very similar to Darden's successful turnaround a decade ago. Darden's retired COO has actually joined the board. Bloomin's got a new CEO and senior brand leaders that have all provided input into the transformation plan. And management's focusing on the largest banner, which is Outback. So there's long overdue store remodels that are happening next couple of years. Enhancements to the menu, table service, new investments in technology, and marketing should be rolling out later this year. So we think there's an improvement as the year progresses in traffic that's going to leak into next year. The shares are significantly depressed. There's no value for that transformation plan. Currently trading near 3 times on a forward EV to EBITDA multiple versus peers at 11 to 13 times. So as the store remodel program winds down, the company should see significant improvement in free cash flow. Today, we're trading at greater than 50% on normalized free cash flow yield. The firm also recently made an investment in Portillo's, symbols PTLO. So again, with another name we'd highlight that's an interesting opportunity today, which is a smaller market cap name within restaurants. And with that, I'll turn the call back over to Bill.
Thanks, Dan. I just want to hit a couple high points or just a couple highlights of why each fund. We just gave you our high-level thoughts as well as the data on why we think SMID and value are likely to do well. Now I just want to show you the positioning and the valuations in some of our funds. So in the income fund, the price to free cash flow multiple on that is 10 times across the portfolio versus 34 times on the S&P. So you're buying this portfolio at a 70% discount to the S&P. One other thing I think is really important to flag regarding income, this rhymes with what we were saying earlier on valuation, capital intensity likely to do well in a world where capital has a cost again. This is a portfolio with a 4.5% dividend yield on it. Compare that to the S&P at, I think, 1.4% or 1.2%. It's even lower than that. That's a 50-year low for the S&P on dividend yield. And so oftentimes in markets, it's a good strategy to fade extremes. This is an extreme collection of securities or valuation set. When you look at the capital allocation policies and where they're kicking off the cash flow and how that all feeds in the composition of the index. So you can fade that by purchasing the income fund, which has, again, roughly 3 times the yield of the market and a positioning set that we think is really compelling. So that's the income fund. And again, 3/4 of that portfolio's equity holdings are in small and mid cap. That means less than 10 billion in equity cap. So MBPA, this is our appreciation oriented ETF. Price to free cash flow multiple on that is also 10 times. So you're buying it at a 70% discount to the market. And MBPA's EV to EBITDA multiple is 9.4 times. So you're buying it at a 42% discount to the market, 16 times multiple. And a price to earnings multiple on a trailing 12 months basis is 10.5 times, which is a 55% discount to the S&P at 23.5 times. So we think all of that's really compelling. And then also when you consider the fact that we're the largest investors in all of our funds, you have huge manager alignment. And at 60 basis points, MBPA is lower cost than 4 out of 5 funds benchmarked against the S&P. So you have aligned management, true active and independent management in a concentrated portfolio at a fair price. And we think that's pretty hard to find out there these days. And then MVPL, let's talk about that through today, actually, hot off the press. Through today's close, MVPL is up year to date 4.2%, which is, again, it's versus if you look at it, if you were fully levered all the time, you would have been up 4.4%. So we're giving you 95% of fully levered S&P. But our year-to-date max drawdown has just been 12% versus 19%. So if you were in the 2 times product. So we haven't even seen the types of environments yet where this was designed to help protect against drawdowns. We've seen one just of late. Again, we were down 12% in that versus 19% if you'd been in fully levered. And if violence continues and drawdowns continue, you're going to want to be in a levered product where someone is actively using quantitative market-driven indicators to hopefully protect against some of that downside risk. And again, we have a very large personal position in that fund as well. And we got a ton of really good questions, so I am going to turn it back over to David now to kick those off for us.
All right, before we start our Q&A segment, just a brief update on upcoming travel events and media. I'll be in Omaha for Berkshire Hathaway's annual meeting, April 30th through May 3rd. If you're in Omaha, then let me know. We can meet up, or we can at least share some notes on events to consider while you're in Omaha for that weekend. May 19th and 20th, I'll be in Richmond, Virginia for 3 value conferences, the Markel Reunion, Value X Charlottesville, and the Fordham Gabelli's Ravati Live Value Panels. If you're interested in meeting up there, let's chat. Earlier in the quarter, Bill Miller IV sat down with Barry Ritholtz on Bloomberg's Masters in Business podcast. They covered Bill's journey to CIO and the influences that shaped him. You can find the episode on Bloomberg's website, YouTube, and most other podcast platforms. Bill also appeared on CNBC's Closing Bell earlier this week, where he noted that market leadership is broadening and valuations outside the most popular stocks reflect significant pessimism, countered as strengthening fundamentals beneath the surface. You can watch the replay on CNBC's website. And finally, check out our YouTube channel. In fact, please subscribe. There's great content, including Bill's commentary at the New York Bitcoin conference in February, where he argued that many technical and demand-driven indicators are lining up for Bitcoin, creating a powerful structural tailwind. We've received a bunch of Bitcoin and digital finance-related questions, so we'll expand upon this in the Q&A. Again, subscribe to our YouTube channel, follow us on X and LinkedIn, and do sign up to receive quarterly commentaries and other updates via our website, millervalue.com. So moving to Q&A. Again, as a reminder, if you have a question, click the Q&A icon at the bottom of your screen and then type away. So we'll start here. Can you please describe how you incorporate macro factors into your approach and within the stock selection process, including any headwinds from higher interest rates impacting the debt rollover risk, US dollar exposure, etc.? So I guess we can start with Dan.
I guess maybe from a deep value perspective, I don't ignore kind of the macro side of the equation, but each kind of investment's unique. The investment approach is more micro focused, where we're kind of doing more detailed plans on the company's turnarounds. For stock selection, we focus obviously on, asset-based business model improvement. We've highlighted, historically adequate liquidity, debt structure flexibility, and management. However, when I do scenario analysis for valuation, we'll look at kind of the key macro items that will affect kind of results. And so I would say that's probably the greatest place where we would tie in from a macro side.
There's also another question I know, David, so I don't want to steal your thunder on it, but I think it's good to group these together. Somebody else asked, if you think in the US that there was a recession on the way, how would you change your portfolio and investment strategy? Um, well, if you knew a recession was coming and no one else did, you'd put your money in cash and bonds. But I would actually question the overall premise of macro forecasting in its entirety, just because the economy tends to grow most of the time. Things that knock it off kilter are out of left field and unforeseen. I wrote a shareholder letter in 2023 called Who's Afraid of an Inverted Yield Curve Anyway? And in that letter, it's on our website, I flagged that there's a US recession probability forecast on Bloomberg, which is the median forecast probability of recession over the next 12 months taken from all the Wall Street professional economists. And back in February of 2020, it was a scant 25%. Soared during COVID at April to 20 in April 2020 to 100%. And when you actually went back and looked at the NBER's date of the recession, it was from February to April. So no one saw that recession forthcoming, and everyone thought a huge recession was going to come after April, and the world was going to collapse, and it didn't. So it's forecasting that is rough to do. It's much easier, as Dan pointed out, to look at securities, what expectations their valuations are implying, and figure out where they're off than it is to forecast the macro.
This next question probably ties into that. You probably have a similar answer. What is your view on inflation 3 to 5 years out?
Yeah. So my starting point for this is what is the market telling us? And I don't really have a view that we're going to be over or under it one way or another. So this is what I tell you. The 5-year rate of inflation implied by bonds markets, tips versus nominal yields today is 2.67% annualized over the next 5 years. And just for reference, that's popped up from 2.25% at the very beginning of this year. So expectations for annualized inflation over the next 5 years have accelerated, driven mainly by the short end of the curve just because of the oil price spike.
They're great. Thanks. Next question is related to Miller Value Partners being headquartered in Sarasota. Is it difficult to find talent within Florida?
So we're remote first. We get access to all the information we need anywhere in the world from the best analysts remotely. We pay for research. We get everything from the street. So we have all the information. But no, there's actually a lot of smart people too who want to be in Florida, who like low taxes, great weather, um, good governance, and year-round golf. So there's a lot of good reasons to be here.
Good stuff. There's the obligatory Blue Owl question. Any thoughts on the alternative asset managers like Blue Owl, ticker OWL, and Blackstone, ticker BX?
Yep. Well, one of the big pieces of controversy around this, and I'll loop this into the answer to the question, to another question, which is private credit, right? Blue Owl's major private credit manager, private credit fears are that loans that shouldn't have been extended were, and they're not going to be repaid. So I like to actually start again with what's the market telling us. And so the poster child for all this would be Blue Owl's BDC. OBDC is the ticker. It trades at a 22% discount to book value. If you figure out what that means based on its leverage profile, it means that the market right now is roughly pricing in losses on private credit in that portfolio at 10% losses in aggregate. That could be right, but that's where they're pricing it in at the BDC level. That's a different question than, okay, what do you think of the manager stocks, the alts, the Blackstone, Blue Owl as a manager? Given that how much Blue Owl stock is down, the multiples obviously collapsed on it. I'm not sure how much growth there's going to be, but it only trades at 10 times earnings. So it's probably not a bad bet over the long term at this point. I don't know if people saw, but Blue Owl Capital Corp, I think just the other day did a deal. PIMCO took down all $400 million of the bonds they issued. The bonds, obviously, they're very much over collateralized since it's only about 1-to-1 debt to equity. So they're not expecting losses in those. They traded about a 6% yield, those bonds do. But Blackstone, what are my thoughts on Blackstone? Well, it trades at actually a below market multiple on next year's earnings, despite being a better business in the aggregate than the market, better returns on capital. So I think it's probably not a bad bet over the long term at this point.
Okay. Maybe Dan, both of you could probably tackle this one. What are your thoughts on the Iran war? And specifically, how do you stay bullish about the markets when oil fundamentals have changed so much?
I think the key thing from a risk side, I think everybody knows that the Strait of Hormuz is important, not only for trade, but thinking about just what goes in from oil prices, helium, agriculture. So there's an impact from that perspective that's obviously was priced in pretty significantly into the market. But I kind of come back to what we highlighted in the restaurant industry is, this creates volatility across the market, and I think the market indiscriminately trades off based upon thoughts on what could happen extrapolating into the future. And as value investors, that's where you find great opportunity sets to take advantage of the market. So um, I think, as we look through, I think the consumer is areas that have perked up different locations. And I think there's a question later we'll talk about, which is even though the energy names have traded down, I think that's an interesting sector too, because where we underwrote that group and thought about them was oil prices around 65. So we don't think we're going back to a sub 60 environment probably in the near-term horizon.
This next question is difficult probably to answer without knowing more about the questioner, but what are your asset allocation recommendations? And maybe look at it as someone in their 30s versus someone in retirement on a fixed income. Maybe it's sort of the 60-40 revisited type question.
No, it depends so much on your personal situation and risk tolerance. And, number one, I mean, how much you actually need to draw against that pile or set of returns every single year. Um, that's the biggest consideration, I think. So it's really hard to say without knowing the person's situation and what's going on. I just for reference, I'm over 100% equities. And well, Bitcoin is actually a major position for me.
Thank you for that. And on to Bitcoin and related, we've got a bunch of questions here, so maybe I'll try to break them up a little bit here. What are your thoughts on the Bitcoin cycle, Bitcoin's price range over the next few years? Does Bitcoin retest 60,000?
When I was on Wapner 2 months ago, I said that I thought we'd seen the bottom at 60. I still think that's the case. I think this is probably the best setup for Bitcoin I've ever seen. Um, for a couple of reasons. So, number one, the fundamental case is as strong as ever with deficits through the roof all over the place. Um, but then the other part of the fundamental evaluation case for me is the fact that it's a superior set of attributes than gold to be a check and balance on fiat behavior. So it's a superior technology functionally, superior set of governance. But right now it's almost as cheap as it's been in many, many years relative to gold. So if you look at the upside to Bitcoin, if other people viewed it as I do, we've got 23 times upside right now from the current price, which is just because of gold has had such a good run. The other thing is gold's historical runs of outperforming Bitcoin have generally lasted about 14 months. It stopped outperforming Bitcoin around a month ago, and that was 14 months since its outperformance started. Not that there's a huge amount of statistical significance to that, but gold's probably not going to go up forever. And again, Bitcoin's a superior technology for its stated purpose. So I think the fundamental case is as strong as ever. Um, so yeah, we like that one a lot.
Yeah, thanks for that. Actually, we did get a question on what's your view on gold, so thanks for elaborating. This one's a topic du jour as well. Can you share your views on your investment in strategy, ticker MSTR, as well as Strive, ticker ASST, and digital credit investment opportunities?
Yeah, so MicroStrategy should perform effectively like levered Bitcoin. It doesn't have a huge premium anymore to its net asset value. So we like the equity fundamentally. Just we've talked a lot about Bitcoin and why Bitcoin, why we think that's superior to proof of stake technologies as a fundamental core layer for capital. You can look at all that stuff on our website. Just go search for Bitcoin in there. Regarding stretch and digital credit, that's actually a really interesting dynamic if you look at what's just gone on over the past few weeks or months. At STRC stretch, which is where a lot of their marginal liquidity is coming from to go into Bitcoin, it's held, I think, 100 now for a remarkably long time. STRC. And the liquidity is just going through the roof. So it's a super popular product, not surprisingly, because everyone wants no vol and 11.5% yield. Um, but it's interesting that it's, held its level and seen its liquidity expand. So I know the company is incredibly, if you pull up the chart, price chart, yeah, since early February, it's held 100. And liquidity's just gone through the roof over the past month too, the volume, which is interesting. So we like that. It's an interesting concept. We think it's safe relative to a lot of people's fears around it. Most of the time when everyone's talking about, oh, this is unsustainable, this doesn't work, it, you know, and it's still working and it's all over the headlines, it's probably not where the next surprise is going to come from. We've done a lot of work on that and are confident with the collateral and liquidity underlying all of that capital structure. So we like that one a lot as a way to get exposure to Bitcoin.
Great. And then I'll combine these two. Any opinion on Ethereum, Bitcoin miners, or Bitmine emerging technologies, symbol BMNR?
Yeah, I think stablecoins are the real deal. And Ethereum is a base layer for a lot of the most popular ones and the most widely used ones. So that will probably work too. But again, my just fundamental view is that the open governance, transparency of Bitcoin, the energy intensivity, the marginal unit creation is just all fundamentally superior to those proof of stake ideas. So I think it's just a better risk adjusted play for the long term. But again, Ethereum and Bitminer are probably good too.
And then this one, what caused the recent weakness in Figure Technology Solutions, ticker FIGR? Maybe just quickly, what do they do? And then you can answer the weakness.
They're a leader in real world asset tokenization, predominantly via HELOCs, home equity lines of credit, the largest non-bank HELOC lender these days. And they're bringing it all on chain. Um, and they're, again, they're the leader, and this is a massive addressable market. So just that one market alone, if they continue to move on the track they are, the stock will be worth many multiples of where it is today. But they're also looking at doing other loans. It's immensely profitable. The technology saves tons of time and money in origination and servicing. Blockchain technology does. The recent weakness has just been because I think crypto, quote unquote, has been weak and it trades like quote unquote crypto, even though it shouldn't. It's just applying blockchain technology and a new type of technology to an old financial market, which is massive. And so it should just be a production-based thing. I think the pullback's probably a buying opportunity.
Okay, two more individual stock questions. Where does Amazon go from here? And any views on financial big bank stocks like JP Morgan?
Um, yeah, Amazon is an absolute behemoth. It's a juggernaut. It's going to continue to dominate. Um, it's not crazy expensive. The free cash flow yield's gone down a lot just because they're investing so much money. Um, but if you EV to EBITDA multiple in 27 is 10 times. That's pretty good. You just have to have confidence that where they're putting the money is going to have a good return a few years out. We don't own it in MVPA at the moment. We own Mercado Libre just because the valuation on it is comparable on just earnings, but it's growing at many times the rate that Amazon's top line is growing at. It's addressing a market that's underpenetrated relative to the ones that Amazon's in. So it's got a better growth profile, roughly at the same valuation. And it's a, diversifier too, because it's in Argentina, Brazil, Mexico, predominantly in Brazil. But we like Amazon a lot. I think that's a great one. And then you asked about big bank stocks. So JP Morgan, I'd imagine it's fine. It's durable earnings growth. Trades, I think, at the highest multiple it has in maybe 15 years, but it's still only 14 times versus the market. I think they're probably a good investment overall, but we own financials that we think are probably less expensive than that.
Okay, I think we had some questions on that too, so hopefully we can get to those. I'll hand it back over to Dan on this one. Any update on Geldwen Holdings, ticker JELD, and their runway to margin recovery and free cash flow generation?
Yeah.
Yeah.
Yeah, so obviously Geld's been struggling with the ongoing housing weakness that's been transpiring in the market. For those who aren't familiar, it's a multi-year transformation similar to Masonite, where the company's already taken $350 million of fixed costs out of the business, consolidating manufacturing distribution footprint. And then fourth quarter, they took out another more than 10% of the North American headcount, and then they're phasing in price increases second quarter, so this quarter. So those two combination events in our transformations historically, we've seen directional improvement in margin profiles that usually take place and roll out over the next couple of quarters. So we'd expect that to also happen here. And so if you think about just where the securities being traded today, the equity looks like an expiring call option. Market cap's 100 million. They have 3 billion to 4 billion in revenue. 4 billion would say is more normalized, 3 billion today. And it's got an infrastructure that is a number two, top player in U.S. market, North America market, European market, and you're sitting on real estate in excess of 10 million square feet that's owned. North American distribution assets that generate 300 million revenue, European assets that have 1 billion revenue. So we think there's plenty of assets here, and we think that the equity is significantly mispriced. It's very similar, in my opinion, to Fossil. If you just think about coming out of last year, tariffs were announced, it traded under $1. The debt traded a big discount, and obviously they refinanced the debt in August, and their debt was due 18 months forward, similar to Geldwen. There's no debt due in the next 18 months, and they're sitting on close to $500 million in liquidity. So again, obviously there's challenges near term, but we think the equity is significantly mispriced, and the bonds, in our opinion, which have traded off similar to the equity, the long duration bonds look ridiculous, in our opinion.
Here's a question that came in. That's a good one. Which of the company management teams you've interacted with are you most impressed with, and why?
Actually, most of them. So in the past, I'd say we've made the mistake of buying processes that just looked cheap and where the management teams were less impressive. We're putting a lot more emphasis today on actual process and the whys of what people are doing. I think a name that doesn't scream optically cheap, but where we think the process is really, really good would be Instacart. Uh, so that one, if you just read the shareholder letters, I think they're very well thought out, and they're very long-term thinking. Um, but we actually like most of the management teams now a lot of pretty much all of them we like at this point, where we couldn't always say that, I think. Dan may have a different perspective.
Yeah, I would just add to that just from thinking about turnarounds, transformations, you got to have management, CEO, CFO that have experience. So we're trying to hopefully find those as part of the screening process, before we kind of make that investment. So that kind of gives us some confidence of being able to implement the plan longer term and kind of underwrite that.
Great, that's good. Um, Regarding the Miller Income Fund, what about BDCs? Are they suitable now for the income fund?
One of the challenges with BDCs, and there's a couple of them. One is that they have fees on them, right? So you are paying fees. But two is that you actually have to disclose those fees, even if, let's say, the stock's actually undervalued and you can earn an excess return. It's good for shareholders to buy it. Even if you do buy it and put it in the fund, as part of your disclosures, we then have to say, okay, this is what we're charging our shareholders. And then we get all these calls about why are your fees going up? Why are you charging 2 to 3%, even if it's the right thing to do? So we're tending to stay away from trying to trade those as much as we have, because number one, there are fees, and number two, it actually looks bad optically. And number three, I don't really have a very clear opinion as to whether or not all of these valuations are right or not on a lot of these loans, and we won't know that for a little while. So, A, not a lot of edge. B, optics and fee issues.
Great. Dan, when do you think the market will realize the value of gray media, GTN?
Yeah, so that one obviously had a slow start to the year. It was actually down weakness because they had a dispute with one of the retransmission agreements. And then you had Nexstar, who's doing a large M&A transaction and was held up by a judge that should go through over the next couple of weeks. So if you look at since that time period, I think the stock's now up, looks like about 18% year to date. So it's had a nice recovery. I think it's hard to always tell for timing. I'm looking at three things this year that I think are going to help. Closing their station swaps, small accretive acquisitions should be this quarter next. And then you have an advertising midterm elections. Gray is the way you play that. They're basically the largest number one, number two platform in the US. They over-index to political advertising. So there's 400 to 600 million of free cash, basically that'll come out of that higher incremental spend this year. And then the last one is just the retransmission agreements. They're all accretive. New management or new CFO has been pushing those through. And the combination of those three, when you look at the trailing 8-quarter EBITDA, which goes into the debt covenants, that should actually start to grow again late this year into next. So you can start to organically delever just from growth in EBITDA, not relying upon debt reduction. So again, stock looks ridiculous, 2 times earnings. The 31 debt has improved, but still in the high 70s, looks incredibly attractive, and there's no debt maturities through the end of 2028.
And the next one is a international outperformance question. What do you believe the driving force behind international stocks' relative outperformance in 2025 and 2026 before the war started? And do you expect this trend to regain momentum?
One of the biggest factors would just be overall dollar weakness, I'd say. So, the dollar's gone, the Dixie has gone from about 115 in late 22 to 98 today. So that's an enormous tailwind for anything that's not denominated in dollars. So that would be one. Two is that emerging markets had a bad run for a long time. And valuations, I guess, have gotten maybe a little washed out. I don't know if Dan has another perspective, but the dollar is clearly the largest driving factor in my opinion. But the dollar's kind of found some level of stability in here at the moment. We'll see how long it lasts.
Yeah, I just kind of add on to that. I think if you look at the trailing rolling kind of 10-year returns, international versus US market, it looks like small caps versus large caps. So they're kind of at that all-time low. And I think that's a great opportunity to think about areas when you want to tilt into an overweight because it's underperformed by the degree it has, and then roll valuation multiples, better yields, dividend yields. I think it's interesting.
Agreed. This one's on AI. Is the AI boom going to continue or come to a screeching halt?
Um, I'll reference that Bain study that I like to reference that just found that in the aggregate, if you look at the total amount of money that's gone into AI over the past, few years and everything that is planned, how much marginal revenues the industry would need to generate to actually justify it from an ROI perspective. And it's more than the revenues of Amazon, Microsoft, Meta, pretty much all the Mag 7 combined. And those companies have been around forever and they're all massively dominant, fast-growing tech companies. And so we got to replace all of those in the next few years. So I think it's going to be a winner take most for a lot of still the big tech companies are going to be the big winners from it. Screeching halt, I don't know. You know, if it's one of these things from an industry dynamic perspective where there's tons of capital going in up front and it's a right race to the bottom on pricing, that would be an ugly scenario, because there's all this fixed capital on the ground and then they just want to get as much money from it as they can. That's bad from a pricing perspective. But I don't know if it'll be a screeching halt. It's an enormously powerful technology and it's going to change a lot of things for the better. So
Okay. So we got questions on, I'll let you guys choose. Update on master brand thesis, conduit. What's the probability of them achieving $5 per share? And then maybe those two. It's a good start.
so
Conduit.
I'll hit.
Yeah,
I also saw somebody ask about bread, whether it's
bread. That's
overvalued or
right.
not. That's one of our
Yeah, bread
larger
financial.
holdings, and I would just flag that that's breaking out. Um, it's breaking out to a new high. It closed at a high on today. Is it overvalued at 8.5 times when JP Morgan trades at 14 times? Obviously, very different businesses, but no, I don't think it's overvalued. It's going to grow earnings 15% next year, and it's loans that people have to pay. So, it's a relatively, counter-cyclical set of cash flows and growth. And so we still think there's upside in that one. They bought some new distribution platforms online. And we think it's a good one. So I don't think it's overvalued. Someone else asked about Master Brand, and I think the American Woodwork acquisition. Yeah, I think the dominant player in cabinets. The real challenge and the reasons for underperformance is just that housing has been weak. And I don't know if you saw, but mortgage rates spiked on the heels of the fighting in Iran too. So. But again, this is an opportunity. The yield curve's already flattened, and the next step at the margin is improvement, and stocks look forward. We do think that's worth more on a normalized cash flow basis and just over the course of a cycle and where it is at the moment. But there are ways to get cyclical exposure outside of that too. So we still like it. But again, it's been weak because of housing.
And then I think this should be the last question, just regarding Stellantis. It's in a hard place, but could be a great value with much appreciation for MBPA. Have you thought about that?
Yeah, we don't own it at the moment. Um, it certainly looks like the chart's shaping up a lot here. Uh, and again, to your point, it does look really, really cheap. It's just that a lot of the thesis went out the window when they made those missteps earlier in the year. So, and switched management altogether. So, the thesis was broken. When the thesis is broken, a lot of times it's good to pivot to new ideas and new sources of potential ideas.
That would you look at an Exor, which owns a significant amount of Stellantis, but also has the Ferrari ownership, which kind of wags the dog.
Yeah, it's a compelling name just because of the alignment with a bunch of really smart people. I haven't actually done a lot of work on it though.
Okay. Well, thank you. That was great. That concludes today's Miller Value Partners live update. Thank you again for joining us. Remember, you can follow us on X and LinkedIn and YouTube channel, and also our website, millervalue.com. So we encourage your questions, suggestions, and other feedback, and look forward to updating you again in July.